Explaining basic financial concepts you should understand. Number 1. Banks. You enter a bank, hand your cash to the teller, they count the bills, smile warmly, and confirm it's been added to your account. You leave thinking, perfect, now it's locked in a secure vault somewhere, probably guarded by security systems and possibly a mythical creature. Reality check. That money's already been deployed elsewhere. Most people conceptualize banks as giant safes with one primary function: protecting deposits. The truth is, they're intermediaries, matchmakers for financial exchanges. When you deposited that $1,000, the bank immediately loaned out $900 to someone financing a jet ski purchase. This mechanism is fractional reserve banking. The premise is simple. Banks only need to maintain a fraction of deposits as reserves because statistically, not everyone withdraws their full balance simultaneously. Unless, of course, it's 2008, when panicked masses formed lines demanding complete withdrawals, triggering systemic collapse. Banks profit by lending your deposits at rates exceeding what they pay you in interest. That's the entire business model. You represent the money supply. Borrowers represent demand. Banks incentivize deposits for multiple reasons. Digital transactions and transfers prove far more convenient than carrying physical currency constantly. They compensate you for holding funds with them through interest payments. Your money stays significantly safer in a bank than hidden in your bedroom furniture. In the United States, most banking institutions carry insurance up to $250,000 per individual, meaning government backing guarantees your funds up to that threshold regardless of circumstances. Number 2, interest. Picture borrowing $1,000. Repayment requires $1,280. Why the difference? Interest. Interest represents money's rental fee for existing in someone else's possession. When borrowing, interest is the cost of accessing someone else's capital. When lending or saving, interest rewards your patience and financial restraint. 2 primary categories exist. Simple interest operates like a flat service charge. Straightforward transaction. Compound interest means every dollar you borrowed now generates offspring, and those offspring also demand payment. Imagine carrying 20% interest on a credit card. You miss one payment. Now your interest compounds on itself. Suddenly that $12 lunch purchase transforms into a $50 regret. Conversely, investing with 7% annual compound interest means your money replicates itself exponentially. $100 becomes $200, then $400, then eventually you wake up elderly, wealthy, and slightly smug about your financial decisions. This explains why interest serves as the invisible force powering both prosperity and poverty. In debt, it's the gradual burn transforming minor errors into financial catastrophes. In investments, it's the delayed explosion converting modest contributions into substantial fortunes. The strategy? If you're paying interest, eliminate it aggressively. If you're earning interest, let it accumulate, nurture it, give it time to work. Interest either destroys you or builds your wealth. The determining factor is which side of the transaction you occupy. Inflation. You purchase a bag of chips, tear it open, and notice it appears partially consumed already. You check the receipt. 30% higher than your last purchase. Congratulations, inflation just hit you. Inflation describes money's gradual value deterioration over time. Not dramatically, not suddenly, just steady erosion. Your father bill technically remains filed, but it purchases fewer ramen packages, less gasoline, and carries diminished actual purchasing power compared to before. What drives this phenomenon? Sometimes excess money floods the system. Everyone holds cash and wants identical products. Imagine 2,000 buyers pursuing a $500 television, but the retailer only stocks 1,000 units. The business responds, high demand detected, price now $800. Alternatively, supply chain disruptions increase production costs for goods or services, forcing price increases. Sometimes expectations alone trigger inflation. If consumers anticipate rising prices, they accelerate spending now, actually driving prices higher faster. Economic self-fulfilling prophecy in action. Moderate inflation is standard, even beneficial. 2% annually, manageable and predictable. But when inflation spikes, savings erode, wages stagnate. Governments combat this by raising interest rates. Higher interest rates mean increased borrowing costs, reducing disposable income for purchases like televisions. This decreases overall spending, effectively cooling economic activity. Recessions. A recession occurs when economic activity contracts for at least 2 consecutive quarters, 6 months simplified. One moment, everything seems stable. You're employed, expenses are managed, perhaps planning family vacation. Suddenly, layoffs commence. Stock markets decline continuously. During recessions, employment vanishes, corporations slash budgets, and consumers hoard cash for essentials rather than discretionary purchases. Why do recessions happen? Multiple potential triggers. Elevated interest rates making borrowing prohibitively expensive. Global crises, warfare, pandemics, rogue cargo vessels. Or simply the economic cycle executing its natural pattern. Expansion, peak, contraction, recovery. Visualize the economy as a celebration. During boom phases, everyone's energized, resources flowing freely, but eventually warning signs appear. Reality intrudes. Someone reviews their financial situation. Suddenly, the atmosphere shifts to contemplation about corporate restructuring. Recessions aren't permanent. They're resets, painful but temporary. Governments might decrease interest rates, distribute stimulus payments, or simply wait for consumer spending to resume. Eventually, purchasing returns, businesses reconstruct, growth continues, but scarring remains. Credit scores. A credit score is a mysterious algorithm possessing your identity, your history, and documentation of every late credit card payment from your college years. A 3-digit number determining whether you qualify for housing, transportation, or face crushing 27% interest rates on your new television. This number doesn't measure wealth. It measures trustworthiness. Lenders want assurance. If we extend credit to this individual, will repayment actually occur? The scale ranges from 300 to 8,050. Below 580 signals serious risk. Above 750 radiates responsible adult credibility. Most people exist somewhere between 640 and 790. Calculation methodology, payment history, timely payments. This factor dominates. Credit utilization. What percentage of available credit are you actively using? Credit age. How long have accounts existed? Credit mix. Cards, loans, mortgages. Diversification helps. New credit. Excessive recent applications hurt. These components determine your score. Improving your score requires consistent on-time payments for all obligations before late payment periods begin. Late payments decrease your score. Your credit score resembles a pet. Neglect it and it creates chaos throughout your life. Maintain it properly and eventually it helps you purchase property. This isn't about actual financial competence. It's about appearing trustworthy to lenders. You can carry zero debt and still possess terrible scores without established credit history. Yes, the system contains inherent bias, but understanding the mechanics lets you manipulate it in your favor. Currency or money. The strange reality about currency or money is its fundamental unreality. Humans invented money to improve civilization. Money simplifies trading, facilitates system building and societal organization. That said, a dollar bill possesses no more inherent legitimacy than Bitcoin. People believe the dollar carries more legitimacy. Perhaps it does currently, but only because collective belief makes it so. The same comparison applies to dollars versus sticks. The sole reason a dollar purchases goods while a stick cannot is societal agreement that dollars hold value while sticks don't. How does money actually function? Governments print it. Central banks regulate it. Everyday people exchange it for goods or services. Banks must regulate supply because excessive printing triggers inflation, rendering everyone's currency worthless. Insufficient money supply means nobody can afford basic necessities. Currency, or money, represents a social construct built on shared belief and trust. Investing. You understand inflation now. The optimal strategy to prevent your money from losing value is investing. Investing occurs when your money stops remaining idle and starts generating returns. Instead of exchanging time for money, you're exchanging money for additional money. The complication is inherent risk. What investment options exist? Stocks. Fractional ownership shares of corporations. If the corporation expands, your shares increase in value. Bonds. Essentially loans to governments or corporations that repay you with interest. Funds. Collections of stocks and bonds eliminating the need to select individual investments. Real estate. Property you hope generates rental income indefinitely. Additional options exist, but these represent the primary categories. Investing isn't about luck. It's about early entry, diversification, and patience. Most wealthy individuals didn't win lotteries. They simply allowed compound growth 3 decades to operate. Yes, investing carries risk. Markets rise, markets fall. But the genuine danger isn't potential losses. It's never investing and watching inflation silently steal your future prosperity. Value. This concept is complex, but universal understanding is crucial. Imagine picking up a rock. It's simply a rock. Now imagine that rock is shiny and gold-colored. That's gold. It's scarcer than ordinary rocks, so humans assign higher value to it. Gold isn't objectively more valuable than average rocks. It's more valuable to humans because we collectively decided it is. Grasping this concept enables wealth creation. Provide substantial value and you'll earn substantial income. Steve Jobs created the iPhone you're probably using to watch this content right now. He created something carrying enormous value. Millions of people paid him thousands of dollars for that value. The same principle explains why doctors and attorneys earn significant income. The value they provide is substantial and people willingly pay premium prices for their services. Value explains why Gucci or Louis Vuitton sells handbags similar to Target's, but charges 100 times more. People perceive higher value. Therefore, it exists. If you determine how to create value, even perceived rather than tangible value, you can generate significant wealth. Time. Time is the world's most valuable asset. The excellent news? Almost everyone begins with abundant time. You probably possess substantial time remaining. But nobody receives unlimited supply. Most people work positions where time directly converts to money. 1 hour equals 1 payment. Simple mathematics. Top earners discovered how to make their time worth millions. The difference isn't mystical. It's skills, leverage, and how effectively you've trained your hours to generate value independently. But nowhere does time work harder than in investing. No greater force exists in wealth building. Not luck, not income. Time. Because wealth isn't constructed in days, it's constructed in decades. Money sitting quietly in investments doesn't merely grow, it multiplies. Gradually initially, then accelerating. That's why ordinary people with modest incomes can retire with 7-figure portfolios. They didn't defeat the system, they utilized the system. Small amounts invested consistently, given sufficient time, becomes substantial wealth.